Good morning, everybody. We are back for the new year. Thank you all for being here. We're going to get started in a couple of minutes. We're just a little bit early here. So just looking to settle in here, and then we will get started here in just a couple of minutes. In the meantime, I just want to check quickly if you guys can all hear me okay and you can see the screen. Just give us a quick yes if that is the case in the chat box, and then we will get started here in just a couple of minutes. Yeah, thank you. Much appreciated. It sounds like I just did my own audio check. It sounds like we're good. So we will get started here in just another couple of minutes. All right. Good morning, everybody. Good morning. Good morning. All right. It is 2 minutes past the top of the hour. Let's get started. Good morning, everybody. And again, Happy New Year. Hope you guys had a good start to the new year here, 2025. This is our first Set the Market morning show here. If you are new, please make sure you subscribe to the channel. You give us a thumbs up like. That way you are alerted when we go live with analysis or we have new podcasts, for example. So please make sure you take care of that real quick. Well, 2025 looks to be quite the year in terms of the set of opportunities. I think if I look back to 2024 and 2023, we had much more linear years. But I think 25 is going to be much more dynamic in terms of the opportunity set. I do expect that 2025 is going to be one where sort of the blind buying the dip crowd is going to start to really start feeling some pain, and the real traders and real investors are going to start to get more rewarded with two-sided price action. That's at least what our analysis points to right now. Well, as you guys know, this is our Set the Market morning show. I'm Serge Berger here from the Steady Trader. And what we like to do here in this morning show is 10-15 minutes, look at some of the top things that's on our mind. So let's get going. And if you guys have any questions, please let me know. Well, we have a big week this week. As you may have seen, we've got ISM services tomorrow. ISM manufacturing data last week came in hotter. We're back above 50 now, which is actually why we still think that risk assets could potentially still be moving somewhat higher. Again, the January dynamics are always tricky. I'll get to that here in just a second. And then, of course, on Friday, you have a jobs number. So, we're early January. How does January typically play out? Well, the month of January tends to be a month where the market tries to sort of find its or a rhythm. And so if you look at the month of January, just from a very simple seasonal perspective, if you look at I have to move this up here. If you look at the left-hand side here, let me quickly make this a bit smaller and try to move it over here. All right. If you look at the left-hand side here of this chart, the seasonality chart, you will see that the month of January tends to be um, really kind of all over the map. You can have, rallies and sell-offs, and, I'm not sure the path here matters so much, meaning it's not necessarily the case that you have to have a rally and then the sell-off. It can happen the other way. The point is January is typically a very tricky month where, we also have earnings season that's going to kick off here next week, actually. Or I think even this week, actually, there's some names that are going to report earnings. Like, I think I was looking at Jefferies and some other stocks that are going to report, the companies that report this week. So it's a tricky month to lean out of windows and take on too much risk. It's a great month to be either quick with some trades or to just watch and see what portfolio decisions one might make from an actual portfolio perspective. So that is just that. Now, what's really crucial as we start looking at this year, and we've been talking about this higher inflation for longer environment now for some time, is this whole notion of the yield curve, which, trust me, this is going to matter to your stocks, right, at some point. And the yield curve is normalizing. In fact, so much so that if you look at this chart here right now, you will see that we actually have a positively sloped yield curve for the first time since basically the summer of 2021. And so since basically late last summer, but before then, I mean. And we're actually at a point now where this morning we have almost 34 basis points of yield differential, or at least we did a couple hours ago. So that means basically we have what's called term premium again. So between the 10-year yield and the 2-year yield, we actually have a positive slope. That's important to understand, and ultimately this could become a problem if we were to see 10-year bond yields go much higher. So that gets me to the chart that I had ready here before. I think 10-year bond yields, are probably okay, sort of where they are right now. I think the 5% mark is where people will start to get nervous, because the 5% mark, 5% is a very attractive yield relative to equities. So at 5% treasury yields, you have to take very little risk to get, probably 3/4 or so of what the equity market might return, if everything goes right. So if the equity market returns 8% this year, which is kind of what we're thinking on the high end, actually, I think it could be less than that, then the 5% quote unquote free yield, is very attractive. And that's, I think, where equity markets could start to wobble a little bit. So, that's something to keep in mind here. So I would watch this very closely. From a portfolio perspective, essentially what that means is the higher we go in yields, the more I would want us to de-risk on the equity side. We're not there yet. I don't think 4.6 is a huge challenge. The next level we have is about 4.7 from last year, April. So we'll see how those levels hold. But again, the more we get towards 5, the more we want to be a little bit careful. Speaking of careful, or at least risk management levels, let's talk about the S&P 500. And for those of you guys that are Inner Circle members, Market Rover members, I typed this into the chat room before. The S&P 500 levels, and I'm going to use the SPY as a reference point here, that we want to look at here is essentially around 580 on the SPY. The reason I think 580 is kind of important, maybe very important, is because it was the lows where the failed Santa Claus rally came from. And also it was the lows 2 days after the Fed meeting. Remember, we had a pretty good sell-off of 3% on December 18th, which was the Fed day. We followed through to some extent the next day. And then the following day, again, Friday, December 20th, was sort of the failed sell-off attempt that then led to a failed Santa Claus rally. So, which meaning that rally lasted for a few days, but then we basically sold off again. So I think that level around 580 is probably where those people that are a bit more near term would want to circle, because I think if we break those levels, we could see a 10% move. And that would then get the S&P closer to maybe 550. So I would circle those levels very closely from a risk management perspective. Again, all that means is that if we were to break those levels, I certainly will look to de-risk. Maybe even before then, depending on what's happening. But we've already seen, quite a lot of stocks turn from bullish trend to neutral trend, or even from neutral to bearish since the Fed meeting. It's been choppy. Obviously, we've had the holidays, Christmas, New Year, and so there hasn't been that much to read into. But that's why I think these are important levels. The other thing I want to watch, and that's something I mentioned in mid-December, right after the Fed on the 18th, 19th, is the possibility that we make lower highs here. And I don't have, honestly, I have no clue whether that will happen or not. But if the S&P does make lower highs, there is a possibility that this could literally be the top for quite a while. Again, it's just a thought. It's not meant to be a bearish comment. It's literally just something from a risk management perspective that I think would be important to watch. So that's the S&P. Now, speaking of levels and things to watch, one thing that we can also watch is a stock like Tesla. Now, Tesla, obviously, a lot of people giddy on the stock. I get it. It makes perfect sense why one would be. But from a risk management perspective, there are some levels here too that I think are important. So you've got a level, and obviously this is a more volatile stock, so you have to be a bit more sort of granular or give it more, I like to call it drawing these lines with a crayon as opposed to with a pencil. But you basically have a support level where the stock bounced off on the 2nd of January, so the first trading day of the year. And I think the support zone it's about $10 wide. It might be more. Again, it's a volatile name, but I do think if Tesla were to give up its gains from last Friday, which it can easily do, and it were to break below the 370 to 360 range, then this too would be just another signal that maybe the market starts to be a bit weaker. Again, these are not forecasts of mine. They're just levels I'm watching, and I'm bringing this up because I think typically early in the year, again, January can be a tricky month, to say the very least. So hopefully that's helpful for those of you guys that are willing to, or that are looking at the market a bit more near term. So that is a few points. I want to show you something else, particularly if you are a trender, a TSD trender user, which is our momentum indicator. We had a classic buy signal last Friday where the stock broke out of a range, and then this buy signal here became valid. We had a couple of signals happening within the range, which we ignore, but we had a buy signal in the trender. This is a 5-minute intraday chart, just so you can see how we can nail these moves. And then that one validated as soon as we broke out of the range. And so that led to a 7% rally, just so you guys know, or 8% rally actually last Friday. So this rally here that I showed you here, this bounce on the daily chart, is one that the trender picked up on with an 8% move. And it's still actually in it. If I were to use the purple line as my trailing stop, it's still in it. So for those of you guys using the TSD trender indicator, watch it closely. Again, I think the trender momentum and trends are going to be very, very, very important this year, because again, I think we're going to have this situation where that blindly asking a dip, that V-shaped recovery environment is probably going to stop working or not work as well anymore as it has for a number of years now. Last but not least is just a trade that we think makes sense here. Again, remember, everything here that we talk about is purely through the lens of education. This is not any recommendations. But there's an ETF out there by the ticker symbol PFIX, and we think yields are going to go higher here. And so, before I talk about PFIX a bit more, let me just say that we're actually long TBT in some of our products. So TBT is bond price, bond yield, excuse me. So we think bond yields, like I said before, 10 years maybe towards 5%. And so we want to be long, and we are long in some of those products, TBT, which is again bond yield going higher as opposed to bond price, inverse relationship. So TBT. Now, another way of doing this is with this PFIX ETF. So what PFIX basically means, it's a bond hedge. So it profits when bond yields go higher, but it also has optionality. They have convexity trades that they do. Basically, they sell options within this product as well. So it's actually quite interesting. So I just want to put this on your radar for those people that like to dabble in different ETFs. PFIX is the ticker symbol for those of you that are wondering what that is. A PFIX. You can go ahead and research it. Just type in PFIX ETF into Google, and you'll find the main website of this ETF. It's run by Simplify. They're good folks over there as well. This is not a pitch on their product, by the way. Just to me, it just makes sense that an ETF like that. So anyway, those are a few things here this morning to get us started on the week, on the month, and of course on the year. I hope this has been helpful. I am traveling all day tomorrow, so we are not going to be here tomorrow morning, but we will be back on Wednesday morning and then again on Thursday. Keith, sounds like you had a nice trade using the trender. Well done. Congratulations. And of course, anyone else that's using that, well done as well. So thanks for joining in. Please make sure you hit the subscribe button. It allows you to be updated in real time when we go live with trades, with analysis like this, and when we go live with podcasts and such, and also hit the subscribe, the thumbs up, like, so that we can continue doing this morning show. Mike, yes, we do think that bond yields are going to go higher this year, higher, not lower. That's what I've been saying. It's part of our higher for longer inflation theme that we've been talking about now for extensively for 6 to 8 months, every day, probably 10 times. So we'll see. Obviously nothing's set in stone, but that is something that is to us rather likely. Again, this is more like a 12-month call as opposed to the next 5 minutes, right? But it's again, that's the perspective we're giving. So the higher inflation for longer theme is going to blow up a lot of portfolio if it works out. The entire financial investment industry is built around disinflationary environments, not on inflationary environments. So I think there's a good chance it's going to come home to roost this year, and we want to actually make money from inflation, not to get punished by inflation. With that, I'll be traveling tomorrow. I'll be back here on Wednesday. Happy New Year. Hope it was helpful. See you guys soon.